As the largest producer of natural gas in the United States, EQT's stock increased 50% since November when Trump was elected, and it's not a surprise why. Over 1 year, EQT's stock increased over 50%, while the S&P 500 increased by about 25%. EQT currently trades at $52.87 as of February 13th close, with a market cap of $31.5 billion, an average trading volume of 6 million shares a day. The analyst's consensus target price is $53, so they're already trading at the target price. Does the company have any upside potential beyond the premium it's already valued at? In today's video, we're diving deep into the fundamentals of EQT Corporation, the largest natural gas producer in the United States. Ahead of their Q4 earnings announcement scheduled for next week, we'll break down its recent earnings, hedging strategies, production outlook, and what analysts are predicting for 2025. Plus, we'll discuss whether EQT's valuation still makes sense in the current energy market. EQT produces natural gas to marketers, utilities, power generators, and industrial customers. They are the only company vertically integrated. They conduct the exploration and discovery, drilling and production, as well as midstream activities such as transporting, processing, and storing. EQT produces in the Appalachian Basin, and its transportation portfolio includes delivery to the Gulf Coast, Midwest, Northeast United States, and in Canada. EQT was the largest natural gas producer in the U.S. until 2024, when Chesapeake Energy and Southwestern Energy merged to form Expand Energy. EQT produces an average of 5.9 billion cubic feet of natural gas per day. The total production of natural gas in the United States is forecasted to be 103.5 billion cubic feet per day in 2024. So EQT produces about 5.5% of all of US's natural gas production. As of the beginning of 2024, EQT held 27.6 trillion cubic feet of natural gas reserves. At the current production rate, even if EQT didn't find any more reserves, they would produce for another 15 years with their current assets. EQT's natural gas production increased 5% year over year for the last 2 years and is expected to increase by 9% in FY24 when Q4 earnings are released. And the guidance for 2025 sales volume is a similar level of 2.1 trillion cubic feet. EQT's revenue from natural gas in 2022 was at an all-time high of $11.4 billion when the natural gas prices reached peak levels above $9. As the prices stabilized in 2023 and 2024, the revenue declined back down to $5.1 billion in 2023. The estimate for full year 2024 revenue is $5 billion, which is 2% lower year over year. This is calculated using the actual revenue of $3.293 billion for the 9 months ended September 30th and management guidance of natural gas sales volumes for Q4 2024 of between 555 and 605 billion cubic feet, and the average natural gas prices, including hedged prices. The 2025 revenue will depend on the natural gas prices and EQT's sales volume. What we do know as of now is that in terms of sales volume, during the Q3 earnings call, EQT's guidance and consensus estimate is to maintain stable levels of 2.1 trillion cubic feet. And in terms of natural gas prices, management told us that 60% of the prices is hedged for 2025 with an average floor price of $3.25. This means 2025 revenue estimate conservatively is $6.2 billion. Which is over 20% growth year over year for 2025. EQT's normalized EPS has a consensus estimate of $1.36 per share, which is lower than 2023's EPS of $2.29. The lower EPS is due to several factors. First, lower average natural gas prices in 2024 by 16% compared to 2023. Second, transaction costs from their merger with Equitrans and divestiture of their non-operating asset. And third, higher interest expense from higher debt and higher depreciation and amortization from assets they acquired. EPS is lower in 2024, but we know that EQT is focusing on strategic initiatives, and EPS includes these non-recurring one-time expenses. So to examine if EQT is streamlining its operations and improving its efficiency margins, let's take a look at their EBITDA. EQT's EBITDA margin in 2024 is estimated to be 63% compared to 43% in 2023. Management has been focused on improving efficiency over the last few years. Major contributing factors of efficiency gains are as follows: less manpower for maintenance, expanding their water infrastructure, and integrating water systems with their acquired company Equitrans, and an overall minimum of $250 million of synergies in cost savings resulting from the Equitrans merger is expected. So, although their EPS is predicted to be lower in 2024, this is due to costs and non-cash expenses related to their strategic initiatives, and their recurring operational fundamentals are showing growth. As for the forward guidance, analysts' consensus estimate for normalized EPS increases significantly year over year to 2.97 in 2025 and 3.85 in 2026. This is assuming EQT does not execute unanticipated major acquisitions in the next 2 years. Operational efficiency is estimated to continue its growth to 67% EBITDA margin in 2025 and 72% in 2026. Consensus for free cash flow is robust for 2025 and 2026, about 4 times increase from $528 million in 2024 to $2.1 billion in 2025, as the company focuses on completing the integration of its merger and reaping the synergy that comes from it. Although EQT shows operational strength, the risk for the company is its high debt position and low cash levels. As of Q3, the company reported only $89 million in cash and $570 million of likely accounts receivables. Their money is tied up in the assets, which is why one of their strategic initiatives is to sell their non-operating assets to free up some of the cash. As a result of the Equitrans merger, their debt increased to $14 billion. After the successful sale of their non-operating natural gas asset, NEPA, on December 31, 2024, they were able to bring the debt down to about $12.5 billion. And it looks like they worked hard to complete this transaction before the end of the year, so it's reflected in the 2024 financials. The company plans to divest additional assets, mainly their minority ownership in the midstream infrastructure assets. On December 30th, they announced that they entered into a JV with Blackstone and received $3.5 billion in exchange for a non-controlling interest to Blackstone. This has added $3.5 billion of cash to pay down their debt. In Q3 earnings, the company anticipated freeing up cash so that by the end of 2025, they reduce their debt by more than half to a level between $5 and $7 billion. This shows the company's commitment to reduce their debt and increase their cash position. Not only commitment, but they are actually already showing their capability to execute on their promise. The company's dividend per share for 2024 will be a slight increase from 2023. Consensus estimate shows similar levels going forward. Dividend yield is pretty low at 1.2%, but this is due to the stock price skyrocketing over the last half year. PE ratio has climbed to an outrageous high. As of February 13th closing price of 52.87, trailing PE ratio is 79 times. That's more than double the median comparable peers' PE of 35. EQT's trading multiple is the second highest, lower than Antero Resources, which is trading at 219 times, but higher than its closest peer, Expand Energy, which is trading at 56 times. However, at the current price, consensus estimate forward PE is expected to go down to 18 times for 2025 and 14 times for 2026. From this, we can infer 3 things. First, the market is treating EQT as a growth stock more than a value stock because of the AI data center energy needs and Trump's lift on the natural gas export freeze last month, which is expected to add 10% more trillion cubic feet of natural gas capacity by 2031. And that means institutional investors are valuing the company based on what it can achieve in the next 24 months and not what they have achieved in the last 12 months. Second, the company's strategic merger to synergize the cost savings is really important, and EQT's ability to improve their efficiency will either make or break the company's worth. Third, because their earnings will be related to their high debt interest payments, their valuation will also be highly correlated to their ability to divest their non-operating assets and minority stake to pay down a significant chunk of their debt. Analyst consensus target price for EQT is a median of $54. EQT is already trading close to the target price. It closed at $52.87 as of February 13th, and the 52-week high was $54.85. With this information we have available from Q3 data and their news releases in the last few months, it seems there's no upside for the EQT price right now. But when the Q4 earnings comes out next week and management provides more concrete strategic plans like their divestitures, any acquisitions, any expansion to their production and sales volumes above their guidance they gave during Q3 earnings, and productive progress on paying down debt, we can reassess the upside potential. We will report back with updated guidance and estimates after their Q4 earnings call on February 19th.